So now I'm going to show you guys each exact time frame alignment and how price reacts on the higher time frame key level to the aligned time frame when you're framing a market maker model. So this is the first example, starting off with the monthly to the daily. We have price on the monthly taking out an external range liquidity pool low. And then price, as you guys know from the previous videos, price needs to move from external to internal range liquidity, which is exactly what we did here. So what we're looking for as price takes out this external range low, we want to see the reaction on the daily. And you could see here, this is the daily perspective on the chart resting here. When we take out that monthly low, what we're looking for is bullish PD rays to form. And you could see we frame a market maker buy model. As price initiates it, creating a fair value gap here, we push up from it. Price then pushes higher, taking out external range highs, retracing into internal range liquidity pools, and then drawing higher, taking out external range high, reaching into imbalances, then reaching finally that monthly internal range liquidity pool target. So that is the monthly to the daily, and now we'll go from the weekly to the 4-hour, and you can see here price takes us into a weekly internal range liquidity pool, and then we can frame the reaction off of that weekly internal range liquidity pool on the 4-hour and frame a 4-hour market maker buy model to that external range high that we have here. So we have a low tag on the 4-hour. This identifies the initiation of our market maker buy model, because we have our tag of our internal range liquidity pool on our higher time frame, and we have SMT divergence occur at the same time. So after we get that, we have a bullish reaction. Price pushes up, we create bullish PD rays, and we just drive higher, taking out eventually that weekly external range target resting here. So that's weekly to 4-hour. Now we have a daily internal range liquidity pool resting here to a 1-hour market maker buy model. So when price reaches this on the daily, tap that gap, create some SMT, then we can go to our aligned time frame, the hourly chart, and we could just frame a market maker buy model to the external range high on the daily. As you can see here, the reaction is very energetic and smooth moving because we have a higher time frame narrative aligning ourselves with our intermediate term perspective. The 4-hour key level internal range liquidity pool to an M15 market maker sell model. We have a 4-hour bearish fair value gap that we tag, create SMT divergence inside of it, and then we can then drop to our aligned time frame, the M15, and look for short positions to resting lows, as you can see here, off of that 4-hour gap. Going from the 1-hour to the M5 market maker buy model, price retraces into a 1-hour fair value gap resting here. And then once we get into that fair value gap, you can then watch the reaction on the M5 and frame the same thing as we did in the previous ones. Try and catch a long entry to the hourly external range highs, because we're doing just simple process. Price is impulsing, leaving imbalances behind, taking out external range highs, retracing into that imbalance to then continue its trend and pushing up to external range highs to continue its original draw on liquidity. Here is the last one, the M15 to an M1 market maker buy model. Price retracing into an M15 bullish fair value gap and internal range liquidity pool, and then price reacting and framing a market maker buy model on that M1 chart to take out the external range highs. So M15 internal range to external range draw, framing ourselves in a long position off of that bullish fair value gap to then go to those external range highs. Very simplistic, very easy concept. You guys can see now how these time frames line in with each other and stay in sync to then keep yourself on your execution time frame tied in with your subordinate time frame, respecting higher time frame order flow.